Welcome to the Dividend Talk podcast, episode 219, analyzing more quarter three earnings. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit europeandgi.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. 1st of November already. I actually can't believe it's going so fast.
Yeah. 2 full months left this year, right? And then it's time to write the annual report again. How's it been going so far for you this year, you feel?
Yeah, it's been a year of ups and downs, hasn't it? It's been crazy. The market's been up and down as well, kind of following that trend. And November is always starts. It's kind of straight after Halloween. I know in Europe it's slightly different. You go to cemeteries and I've lost souls. It's not quite as big over here, but it's always, I find November a good time for reflection just before December comes in. So
to make up, to do kind of a bit of a goal analysis where you are, if you're on track, and whether you need to still correct something for this year.
Yeah. We'll see. I do most of that in October, which is last month. Particularly then you have your spring cleanup. I have my autumn cleanup. But yeah,
nice.
That's how it goes. But we have loads this week. Earnings has been out. Lots of news, and one. I seen your tweet on it. You said you were not surprised about it, but Estee Lauder, our French company, cut their dividend, which was strange if you look at the highlight numbers. I haven't dug deep into it, but what I did see is that earnings grew year on year and revenue grew year on year, but they withdrew their 2025 guidance and cut their dividends. So what's going on over there?
I think it's just China. Well, not just China, but China's having a negative impact. But generally speaking, we got this question the other day, one time on the show, right? L'Oreal or Estee Lauder, and we were clear that by quality, please, right? And we saw both L'Oreal as high quality, but also I wrote about L'Oreal. I think it was the first newsletter that we did.
Yep.
And I compared it there also in a small table with Estee Lauder, and I saw already Estee Lauder minus 10% revenue. Again, revenue decline, right? So this company is just on a severe decline for more than 12 months. And lots of red flags. So I'm really not surprised that they had to cut the dividend. I mean, you don't do it after one poor quarter, but at a certain moment, you see that your business is falling off a cliff, and then you want to preserve cash. You know how it goes with these kinds of companies. We've seen it with LVMH as well. During COVID, they also cut the dividend, right? They also saw like, oh shit, it's going south. Let's be conservative. No, but I think Estee Lauder is just having some bigger problems, I think. And if you then compare it with L'Oreal, where L'Oreal was able to still grow somehow, then it's very telling where Estee Lauder is right now.
Yeah. And look, we did a show recently on China and the impact that may have on companies. And I know there was a small bit of good news that came out a couple of weeks ago as well. That doesn't seem to have trickled to everyone. So it's quite a big risk, China, at the moment, especially to these luxury companies, because they seem to be the hardest hit.
Yeah, the narrative is there that the Chinese consumers are a bit becoming anti-Western. I don't know if that's true. What I mostly see, and we see it in not just in these kinds of stocks, but in many stocks, that Chinese consumer is just very weak at the moment.
Yeah,
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 and if these are luxury products, well, that's probably one of the first things you cut on, right? It's not Hermes, yeah, which goes into the billionaires club. Yeah,
yeah, yeah, yeah. And they can probably make something that's similar to their products but cheaper over there, which they can use as well. So yeah, look, it's a weak consumer. It's having a huge impact all over, and we're starting to see it with the luxury companies first, and
yeah,
then it'll start trickling down after that. But first dividend cut in a while, I have to say. I can't remember the last one. WP Carey, maybe.
yeah, maybe.
I can't remember.
Yeah,
So Philip Morris is also in the news, and that is because they're closing factories in Europe, and more specifically in Germany. I was quite surprised at this,
yeah,
actually. I believe that they're shutting it down because the shipment volumes is down significantly, they
yeah.
said. From what I read, it's 3.1%, but it's obviously enough for them to shut down 2 factories. What's your thoughts on that? I was quite surprised to hear this.
Yeah. That's why I shared this news item, because if you look at the stock itself, is doing quite well. Yeah, Philip
Yeah,
Morris. So, um, what I don't know the exact in and outs, but if you think about it, if you see the youth, I don't see the youth really smoking normal cigarettes here. They're all with these vapes in their hands. So maybe this has just to do with it. Yeah, that's the consumer preferences are changing, and that they see this and that they're just proactive. And I mean, closing something in Germany, I mean, I think let's be clear. I think every traditional corporate will always look at the first opportunity to close something down there.
yeah,
Because if you have a reason to close something down, you will do it, because you don't get a reason too often to do that. And with the German labor laws there, it's hard to do business as any corporate. So I wouldn't be surprised if that also plays a role.
yeah, yeah. What surprised me is the machine builder that builds machines for our plant. We got a tour, and I know that they had lots of big orders from Philip Morris, and that would have
Yeah,
been, when was I over the last? It was only a couple of months ago.
yeah,
And a couple of big orders came in for
yeah,
combustible machines. I'm not talking about vapes or heated
yeah,
tobacco. I'm
yeah,
talking about combustible machines. So I'm wondering if they've upgraded their machines to take that capacity elsewhere. They
yeah.
can bring more volume and close it down. But yeah, closing 2 factories in Germany is it was big surprise for me. But look, as we know,
If it
tobacco,
helps the dividends, yeah,
yeah, tobacco companies have a long road ahead with this shift to alternative products. So
yeah,
maybe that's just trying to save some money before they really
exactly,
tackle it.
exactly.
Yep. And then the last piece of news then came from my end, which was inflation fears in the UK again. I don't know if you probably don't listen to much of the news over here, but they had their budget, their annual budget, which happens, and it got a lot of negative reaction. Government are increasing their spending, they're increasing national insurance contributions, the minimum wage is going up, which is usually good, but somebody has to pay for this, right?
Mhm.
And the government don't have the funds for this, so it looks like they need to borrow these funds. And all this is creating kind of inflationary fears, and there's lots of other stuff going on. This
Yeah,
government is getting hammered at the moment over there. But what that means for us is it could create opportunities within the market. UK market took a bit of a tumble,
yeah.
so some good companies in the UK, and could be a good time to take advantage.
I think there was even a question today on Facebook about why is green coat wind going down? Do you see any relation there?
Yes,
I
of
mean, the
course.
wind is still blowing, right, in the UK?
Maybe it's blown the opposite way. But if you remember when this government came in, typically a Labour government is good
Hmm.
for renewable companies like this because they give funding and incentives. This is not your typical Labour government, and I don't think it's gone as planned. So I suppose those, a bit like that CHIPS Act with Intel, that
Yeah,
initial there's going to be funding and money and all that buoyancy is around, and then that just leaves, and people are depressed, and they start pulling money out of it. So I don't think this Labour government has been as kind as I would have expected, or historically they would have been to companies like
Yeah.
Incoat, which is affecting them. But lots of turmoil in the UK, and it's been like that for a couple of years now. So
Yeah. So, but there are some companies like DCC that also get quite some earnings from abroad, right? So there are some good dividend payers there, and if you are not too exposed to the UK market, maybe even more interesting.
exactly.
Yeah.
So dividend announcements. AbbVie, you mentioned them last week. You were excited to see them. I can't remember what you predicted.
I don't know, but 5.8% to $1.64. It's a nice one. It's such an. I'm now on 9.74 yield on cost, and I would love to see it hit 10%. It would be just, this thing with dividend investing. Does it really matter? Yeah, to some extent. I'm always trying to think like how fast could a company get to 10% yield on cost based on the investment that I'm making. On the other end, it's also just being a dividend nerd. Yeah. And then if you see 9.74, you just think like, can't they just couldn't they do just 1% more or something like this would round up to 10?
Put it into Excel as an integer, and it'll be 10%.
I think we'll just write an email to investor relations complaining about the latest hike, saying that I was hoping to really get my 10% year. Now I need to wait another year. What are you going to do to compensate me for the waiting time?
special dividend, please.
Maybe they give me like an investor shareholder pack, some drugs to try out. Stop complaining.
or they just tell you to sell your shares and leave them alone.
Yeah, most likely. Yeah. Most likely.
ExxonMobil had a 4% increase as well. Were you happy with
that one is a bit disappointing because it goes to 99 cents per share. Like, why not $1 again? Yeah, so maybe I'm just whining here, but they have a very strong balance sheet. Some people saw that on social media. I put like the net debt ratios on the in a graph. So with Equinor actually having a positive, they don't have debt, so they have positive cash position, and then it's ExxonMobil with the best balance sheet in the world, effectively. And yeah, because I'm now writing on a piece for BP, so I started comparing all the oil majors. Will be in the newsletter, not this weekend, but the weekend after, right, when we release it again. So I was really hoping for ExxonMobil also to get to $1 per share. But hey, we don't look a gift horse in the mouth, right?
Yes. And then what about Visa? Another 13% double-digit raise from
they Visa. Keep pulling it off, right?
Yeah,
they keep pulling it off.
Yeah. Did you see this new European legislation around instant payments? Have you seen that? So it's come into Ireland, and I believe it's been rolled out across Europe. Just some EU law or legislation after coming in. Visa and MasterCard are obviously against this, because what it's trying to do is promote fintech and other kind of companies to be able to come in there. And if I send money now, usually if I send money to another bank, even if it's within Ireland, it takes 2 to 3 days. Now it's all instant as of today. I think it's today. It's today, and that could be a bit of a game changer.
But does it bypass their network then?
So it will have some impact, I would imagine. So for example, on Revolut, I don't know if you use Revolut.
Yeah, definitely.
But when I top up Revolut, I still top up with my Visa card because it's instant. If I top up with my bank, it'll still take 2 or 3 days. Now I don't need my Visa card to do that. I can go directly from my bank into that. So they lose those sort of transaction fees. I know Visa and MasterCard came out and were talking about safety, and it'll increase.
Okay, so it's not a law against Visa and MasterCard,
no.
But it's a law enabling the alternative that Visa and MasterCard are probably not too happy with.
Exactly, and they might lose some transaction fees. And
you're not telling me that they're trying to hinder innovation, right?
It wouldn't be like big American companies. No way. No way. But it's interesting. I think it's in Ireland anyway as of today, I believe, and it'll be rolled out then across Europe. So
well, if you look at the margins of Visa, which are 80% plus, right? That shows just how strong the moat is. Otherwise, it would have been deteriorated already long ago. but it also shows like if this one goes to a 60% margin because of innovation and then new competition, then shit will really hit the fan there. But I think Visa and MasterCard, they're so embedded in the entire world that a bit of a competition in Europe will not stop it, I think. What do you think?
No, I don't think so,
No.
but it's still, look, you never know. Innovation breeds innovation too. So you
Yeah.
don't you
Yeah,
don't know
that's true.
you don't know what comes out of it. But I just find it fascinating that we talk about a company that has double digit
Yeah.
dividend hikes over the last 10, 15 years
Yeah,
nearly
yeah,
at this stage, and now there's some competition coming into the
yeah.
market. So
Which is
it's
interesting because I did a tweet the other day on Google as well, where I said like, castle modes were very working well until cannons were invented, right?
yeah,
And with Google, I see this now with just simple like the Copilot in with Bing search or something like that. Yeah, you can now. I'm spending way less time on Google search, and then some people that followed me, they told me to try out Perplexity AI. I tried it; it's awesome. So Google has some serious contenders now when it comes to search.
yeah,
It is really impressive.
yeah.
Yeah,
I almost exclusively use Bing now, and Copilot is fantastic. It even gives me
yeah,
a
yeah, yeah.
summary. It knows what I'm looking for,
Yeah.
and it gives me a summary of my news in an AI generated voice and tell me about this latest stock market news. And it's
Yeah, exactly. And I think Google is. I don't know what's taking Google so long because they have the technology in house. I don't know why they are just not releasing it. Is it the classical case that, for instance, would cannibalize their ad revenue? Because if you look at the Google at the search results, there's not a lot of space for introducing new tools, unless you will take the ads away.
yeah, yeah,
Maybe it's just as simple as that. That the value of the placement is just too costly. We're
yeah.
talking about billions there.
But you're still embedded into the Google ecosystem with Gmail and like well, we're recording as well. Like it's hard to get away from that. So maybe
Yeah,
they're
but if you
banking on
look
that.
at where they get the main money from, it's YouTube ads. Yeah, and how many YouTube ads do you get now? I get sometimes like 4 or 5 ads, and now they're even often not allowing you to skip anymore.
Yeah,
Yeah, so they're really milking that out. And then you have the Google search, and if you search for something like on Dividend Talk, yeah, there's just not a lot of space left. Yeah, for them. So it will be very interesting on how they will do this with the whole, not cannibalizing the ads business. But this is what I mean, like new technology comes around just since when do we have OpenAI? Since the beginning of this year?
yeah. I'd say mainstream probably
Yeah,
beginning.
mainstream, yeah, that it
Yeah,
became mainstream.
yeah,
So we're talking less than 12 months. And look at how yours and mine behavior changed already significantly in this.
yeah. Massively. And what kind of pushed me into that is we have like an incubator system in work, and it's
Yeah.
obviously built off ChatGPT, but it's our own version. And I was one of the early adopters, say, that's testing it, and you learn how to give it the right prompts and how
Mhm.
to navigate it and how it actually so beneficial in writing documents and even
Exactly.
proofreading or
Yeah.
summarizing. It just quickens everything up. So yeah, it's
Yeah.
it's
Well,
it,
Google's earnings were up, right? Full disclosure. And the
yes,
cloud business is on fire. I'm not surprised with the cloud business because I think they're very competitive in pricing compared to the Microsofts of this world. So if companies are looking for cost savings, then Google is a really great alternative. When you think about the Google Suite, but also just the Google Cloud itself is quite strong, I would say. I think even the ads business is still growing, but the fact that it's growing doesn't mean that maybe the underlying trend is already giving some red flags. And I know we're maybe on the early adopter side. Yeah, I don't see the grandparents and the 60-year-old people already fully on OpenAI massively, right? But I think the youth has the future,
yeah,
so they should get worried.
yeah. Yeah, I 100%. If I look at the youth, actually, I spoke with a colleague about this today. I'm glad I went to college before AI, because now what we
Yeah,
what we see is people spend a lot of time on it. doing a lot of stuff for them, whereas we
Yeah.
really had to learn. So you understand. Whereas I don't feel like.
Yeah, but come on, we were neither learning an encyclopedia anymore, right?
Yeah,
We
true.
we started with Alta Vista, yeah, and then also we skipped this and Wikipedia. So it's by all this technological innovation, less and less like such kind of knowledge we need to have stored in our brains, and becomes much more like how quickly can you acquire knowledge, yeah, to do the task, to do the
Yeah.
job. So
Where can you find it the
yeah,
quickest?
yeah. So maybe with that we start losing more historical knowledge, yeah, about history and such, because it may be less important in our productivity needs, which our grandparents, they probably knew much more about all the wars and everything like that, yeah.
Yeah.
But I'm usually quite on the progressive side with the technological innovation there. If it helps, it creates it may create the GDP growth that you and I need to be retired for a very long time. Yeah.
Yes. Let's hope. Anyway, that was a nice little side discussion. Back to dividend announcements. We have one more, which is Rockwell Automation, a company that I really like dealing with them, working with them. And they had a 4.8% dividend hike, and they now have a $1.31 dividend. That's
Nice.
quarterly as well. So yeah, nice company. I haven't looked at them in terms of valuation a long time. I know they were really low yield, which is why I never looked at them. But solid company. Earnings. This is our second week, I think, doing earnings. So we have a couple of companies. And I thought I'd start with AbbVie this week, because I know you were speaking about them last week, and you were expecting a dividend hike, which duly came right on time. So I thought I'd look into them, and they looked like they had quite a decent quarter, I'd say. The revenue was 14.6 billion, which is around a 4% increase, 5% on an operational basis, and the earnings were up 26.5%. Sorry, that was operating income was up 26.5%. The earnings per share is actually up 12%, which is still quite a decent raise. They did some acquisitions during the quarter. So they acquired Cerevel, which expands their neuroscience pipeline. So they kind of target schizophrenia and Parkinson's, and they're really trying to bolster or strengthen that part of their pipeline. And then they also acquired Alida Therapeutics, and that's something with CNS diseases. So strengthening their pipeline, which is always nice to see with a pharmaceutical. We know obviously they have huge risks when it comes to Humira, but Skyrizi and Rinvoq are doing quite well. They saw growth 50%, nearly 50% each, 50 and 45% respectively. I don't know if you watch any American programs, but sometimes I watch American football, and every second ad is an AbbVie product. It's either Skyrizi or Rinvoq. It's everywhere over there. Honestly, it's crazy. I'm not surprised to see the growth so strong.
That's good to hear.
Yeah. Like we're obviously not exposed to it over here, but I see them all the time when I'm watching it. It's nearly every second or third ad. But they're going a long way to offset these Humira revenues, which was obviously a big reason why they were trading down $60, $70, $80 there a couple of years ago. So it's nice to see that growth. Oncology is doing quite well. That's up 12%. Neuroscience, we saw some of the acquisitions up 15%, and aesthetics is up 19.7%.
Oh,
so
nice.
they've lots of growth across all their segments, which is quite good to see. And then lastly, their dividend, which they increased, that's 5.8%. But this marks, and they have this in their report, this marks an increase of 310% since the company's inception in 2013. That's a big number. Have you held them that long?
No, not since then. Let me check since when I have them. It is no, not since 2013, because I started investing in 2014. So I started buying in 2019. Yeah.
But look, overall, I think it's been quite a solid quarter from AbbVie. I'd say as a shareholder, you must be quite happy.
Of course. I mean, it's one of my best performing stocks, both in terms of dividend income and price appreciation. If I just look at it, it's AbbVie for me, yeah, tripled, I think. Yeah, I've got 200% unrealized gains.
Oh,
Yeah, my average price is around 67, 68 or 69, something like that. The current yield is 3.22% and the yield on cost is 9.74. So yeah, tripled, both in dividends and in share price. So I'm very happy with that. The trick was always the debt. Yeah, the debt. And have they been paying down debt? Did you have a chance to look at that?
I did not see anything regarding the balance sheet in the release notes. So I don't know.
Okay, because that's the one that I typically look at the debt, because the debt pay down is for me very important there, because they have a certain target as well. But with the Allergen acquisition, they really loaded up on debt. So what was for me very important to see is that they are bringing it down, which they were doing. Yeah, they brought it down from 77 billion to all the way to almost in the low 50s, and I think that's that's very important to continue seeing this happening.
Yeah, of course. But I think the Allergen acquisition was actually worth the money and worth going into the debt for, because it.
True. Although it would be maybe interesting to do one time a deeper dive on that, because what is really what you also mentioned today is that the immunology department is really growing, right? They bring in 7 billion, and if you then look at aesthetics, it brings in 1.2 billion. So there is why they bought Allergen was mostly to diversify, to not be so vulnerable to a single drug. And that was for me very, very smart that they did it. So they bought the Botox brand and everything. But they still have the Humira patent cliff. And now with Skyrizi and Rinvoq, I expect them to really get to a strong balance sheet, so that when those start going off patent, they don't have the same issue with Humira. Because for me, having Humira replaced by Skyrizi and Rinvoq, it's like winning the lottery. How can you have like 3 blockbusters over that decades in a lifetime? Yeah. Many companies, big pharma companies, struggle with replacing the pipeline like that. And what they start doing after a big blockbuster, they start using that cash to get 10 replacements for one. And they just found 2, that replace Humira. I mean, for me, that's like winning the lottery.
Yeah. It's definitely one to watch with the depth. I just double checked while you were speaking there. The press release has only the statement of earnings and adjusted.
Yeah, the SEC filing typically comes a week later, so they won't release that yet.
Yeah. So we'll check that out next week and we'll revert back to it.
Yeah, no, good one. So, while you are talking about AbbVie, which is a top 5 position in my portfolio, I have to talk about SHEL, and probably people get bored about us talking about SHEL each quarter, but it's just a very large position in our portfolios, and I just have such a strong appreciation for the cash generation that's coming out of it. I mean, it's not oil that is like shooting through the roof. This is just money. I see money flowing everywhere. It's unbelievable what they are doing. And you could argue like, well, oil price, but the oil price took quite a nosedive over the last quarter. Yet they are still generating so much cash. Unbelievable. So in this case, in the third quarter, they had cash flow from operations of 14.7 billion. The capex was 5 billion. So the free cash flow for them in general was around 10.8 billion. There's a bit of an adjustment in there. That's why it's a slight difference. But they, for instance, brought down net debt. So what is important for them is the net debt ratio, which they call gearing. they are bringing that down, and it was a bit flattish over the last year, but now they made a nice decline again from 38.3 to 35.2 billion, which is good to see to come this down, because they have, compared to the other oil majors, they have one of the highest net debt ratios still, and I think the company feels very comfortable with it. But I would like them to go into the direction of ExxonMobil and Chevron, or maybe even Equinor. Just have no debt. Yeah, I mean, you can have debt, but then have cash against it. Yeah, just do that.
Yep.
That's what I would suggest. But what was interesting for me, when you dive a little bit deeper into the numbers of where the operational cash flow came from. So integrated gas and upstream, and when we talk about upstream, this is really the dark black oil, what they're pumping out of the ground. Those took quite a hit in the last quarter compared to the quarter before. But what was keeping it up was marketing and chemical and products. So the refineries and such, and then just the sales of it, that went really up. So I guess while the oil price went down, hitting upstream business, they were not bringing the gas price at the pump so much down, so that they could buy it cheaper, still buy for relatively more expensive, so the margin went up there. Yeah, so if people are complaining at the gas station that there's a difference between the oil price dropping and Shell dropping the gas prices, they have a point there. I still feel that customers cannot complain, because they should go to the Ministry of Economics in each country, because those are the real oil sheiks, right? With the tax that they put on oil.
Yep.
But in this case, you can clearly see it in the results here. And which is quite interesting as well to see one time, right? That it's not just always the oil and natural gas. Sometimes it's also the gas stations that bring in money. I just want to remind again what this company is all about. Yeah. So first of all, they really still think till by the end of next year that they can really grow more than 10% the free cash flow per share. Yeah. They do this, of course, with a lot of buybacks. They bought again back 6.2% of shares over the last 12 months, which is, you only need 4% additional cash flow growth, which they also try to get with cost reductions. So under flat, let's say, cash flow, just the cost reductions plus then the share buyback, they should be able to do this. What's also interesting is that they have committed to 4% progressive dividend annually. So their dividend payments are declining now because of the share buyback. Yeah, so let's see what it will be next year again. If they would do 4%, I would be quite surprised. I expect at least the same as the reduction of shares. Yeah, so at least 6.2%.
Okay.
And it's just from that point of view, under the new CEO, it's so well managed. And I spoke a bit earlier about the gearing, and they have a nice picture in their in their quarterly results, and it's called the balance sheet, continued strengthening of the balance sheet. So I just spoke about gearing, right? And you can see that in 2015 the gearing was around 13-14%. It's now 15.7%, so we're almost there again. But then in a single year, because of the oil glut in 2016, it went up to almost 30% in a single year, because they were just too expensive, right? At that moment in time, I believe the break-even price was around $60-70. Yeah, if it shoots to 40-50, they were just selling at a loss. They then recovered a little bit till 2018, but then the COVID brought it back to 35% or something like that, and this was just too much for them. And in 2016, they also bought British Gas. Yeah, so that's also part of the debt there, and that was just too much. Why they had to cut the dividends. I think they're getting in a much better position now. If they would buy a company again, then they will bring up some risk again with the balance sheet. But I think now if something happens, they don't need to build up the debt so quickly. So I think they're in a much better position now.
I think so, and I don't see the reason why they would buy a company as big as British Gas right now in this moment. So I don't think they need to spend the money. I would much rather see them, like you said, continuing to lower that gearing, much like ExxonMobil, so that they have, especially because it's a bit of
Yeah.
a golden age in the last couple of years since COVID for us. So make
Yeah.
the most of it. And to be fair, they've rewarded shareholders, so we can't complain. But I'd still like to see that balance sheet go
Me
stronger.
too. Me too.
Nice.
So
No,
never sell SHEL, they say. Yeah.
yes,
Let's see.
never sell SHEL. Top 5 position. For me, I think it is for you as well.
Yeah.
So it's always nice to see their numbers. Next one on my list was TROW price. We got a couple of questions from these, one from JC and another one from Alexandra. And I think their share price maybe jumped 4 or 5% after earnings.
Yeah.
And I mean, top level numbers, you can see revenues were up for the quarter, up 6.9%, which is always good. Operating income was up 5.6%. Earnings per share had a 34% increase as well, which is quite strong for them. And cash flow totaled 1.97 billion. So they ended this quarter with a total of 3.17 billion cash and cash equivalents, which is up 1 billion from the start of the year. So they've been strengthening their balance sheet and have that extra bit of cash flow on the side. If you look at their segment performance, again, it looks quite rosy a little bit. So you can see that equity was up 10.6% year over year. Fixed income up 3.2%. Multi-asset grew 14.6%, and alternatives grew 16%. So we're seeing growth across all their segments. But the only thing I will say is that the assets under management, it did grow 21.1%, but all of this was down to how they performed in the market. So they made 74 billion in net market appreciation. Of that, then they had around 12 to 14 billion in outflows. So that makes it, they had roughly around 60 billion. So that's where their assets under management grew. So they've been doing well in their portfolios in whatever equities they're investing in. It grew quite strongly. Their focus is reducing those outflows. It's still quite high. It's been around 14-15 billion for the last few quarters. Obviously, they want to try and strengthen their ETF franchise and branch out there, and it's coming under a little bit of pressure. But with the performance that they see in equities at the moment, and that 74 billion might help ease some, I don't know, what investors feeling. Maybe they're not feeling as strongly about TROW. So maybe that will help them. But look, as always, they have a strong balance sheet. There's virtually no debt on it. And if they can curb those outflows, I think you'd be getting them at a decent price.
Yeah, exactly. For me, it's a very interesting story, right? So if you think about it, they still have no debt. So they've been now struggling for 2 years.
Yeah.
Yet they didn't grow or they didn't initiate debt. Yeah. So stockholders' equity continues to grow. It's up by almost 1 billion. So the company is just really doing well for us, right? So the dividend hike was of course very low, but they have a net cash position. The company is struggling with some of the largest outflows it has seen.
Yes.
And yet it is still growing the shareholder equity part on the balance sheet and not taking on any debt.
It is an example of management doing a really, really good job here. And they are under pressures. And look, you have BlackRock and Vanguard, which are hurting them a little bit with theirs, and maybe KKR. But
does it make them a takeover candidate?
Yeah, potential. I don't know though. Would you have competition laws coming in? Are they too big to be taken over by someone like that? I don't know.
Mm-hmm.
Maybe I would hate to see TROW price taken over by one of the big boys.
Yes, me too. But look, the price went down after earnings, so clearly.
It went down. I thought it went up.
I thought it went down, but maybe it went up. I don't know. You can see how much we pay attention to share prices here when we're looking mostly at fundamentals.
Yeah, but I mean, fundamentally, it's still strong. The concern obviously is around the ETF franchise and the risks around that. But I mean,
but if I look at it, they made like almost 1.9 billion. Is it 1.9? No, wait, almost 2 billion in operation cash flows.
1.97, yeah, correct.
Yeah. And then and they only paid 851 in dividends. Yeah. So the dividend payout ratio is also very strong.
Yeah, less than 50%. It's
Ah,
we're in a good position with T Rowe price.
I think so. Yeah.
Yeah. To answer the guys' questions, I thought those solid results. I would like to see the outflows reduce a little bit, but well managed. Dividend is safe. I think it's a safe company. I'm not adding any more, by the way. Just full disclosure, I have enough, but
Me too.
I like the company.
Okay. So in that case, then let's go to, unfortunately, again, an American company. I wanted to look for, because you did AbbVie, T. Rowe Price, I will do Clorox now. I actually want to do more European, but we have like Ahold Delhaize next week and such. So next week, we'll have a really nice company coming in. Let's see how that goes there. But maybe a bit of a story about Clorox, what people need to know. Currently, it pays about a 3% yield, 1.22 in quarterly dividends, and they hiked the dividend in the last few years only by 2 cents each year, which is very low, like 1.5 to 2%. They just have a 3.85% 5-year CAGR on the dividends over the last 5 years. But then they also, after earnings, said 3.5% price increase. What is very interesting here, and I don't think we discussed it on the podcast at the time of the news in the week, but you do know that Clorox lost a third of its distribution and market share last year due to cyber attacks. So they were effectively for 2 months almost doing everything manually, because if I understood it well, the product lines and everything, they just couldn't use it, So, for instance, when it comes to cat litter, Fresh Step that they were selling, many customers, they went to other brands, and it's really hard to come back to that. But when we talk about the rest of Clorox, most customers and retail chains seem to have picked up again, and they have the shelf space back. So that was, of course, very tricky for them how this will play out. But that's why the sales, when you look at it, the 27% increase is a bit misleading, because you're comparing to a very weak quarter last year at the midst of the cyber attack. So that's also probably not where we need to spend too much time on. What is much more interesting for me is to look at the cash flow statement. So they had 221 in operational cash flow million. Then they spent 39 on capex, so you have 182 left, but they spent 258 on buybacks and cash dividends. 150 is, by the way, on cash dividends, which also tells you 150 versus 180, they have a very large payout. Here, almost 80%. A bit too rich for me for a consumer staple, really. Last year they were, of course, in the minus after this thing that happened. But the why they were able to buy back shares was mostly also because they had some proceeds from a divestiture. So they collected 128 million and used 107 to buy back shares, and that's also why the money on the bank account was still a little bit growing for them. But I find it such a tricky one. And if you then think about it also, they did give a guidance update. So their gross margin is expected to increase. The EPS is expected to increase. So they gave like a 5% upgrade there. So the company is quite, let's say, bullish. They expect to make around 520 in EPS. Remember, the dividend is around 488. So there's really not a lot of wiggle room in that case from EPS. Cash flow, it's a little bit better probably. But then to get a 3% yield and a 1.5% growth approximately per year last 3 years in dividends, then for me it's really not attractive. And I know there are some people really thinking like it's consumer staple, iconic brands. Correct. But shouldn't such a company trade at a 4 or 5% yield right now, not at a 3% yield? That's my issue with this company. I don't think the company needs to cut the dividend. They are committed to it. They will hopefully weather the storm. But pricing it at such a multiple and only giving it a 3% yield with this,
Yeah.
you're talking here about 5%, 4% earnings yield or something like that, 5%. What are we talking about here for a company that had all these struggles with cyber attack as well? That's where I think like the market is really out of whack when I look at a company like Clorox.
Yeah. Yeah, I kind of compare them to Reckitt Benckiser a little
Yeah.
bit. I know they do similar type of products. Then
Mhm.
they typically trade between maybe 3 and 5% at the moment at 4.12.
Yeah.
You would expect at least that from Clorox, given all the issues. Like Reckitt didn't have the same type of issues in
Yeah.
terms of cyber attacks, so you would expect Clorox to be trading at a little bit lower than what they're trading at. Yeah, for me, not attractive at all.
No.
I would stay.
So I look at this company like once a year. This was again that I looked at it. And over the last 3 years, I just don't see the attractiveness in it. I know they dropped in share price as well, of course, at the time. But even at 4%, I wouldn't buy this. Yeah, there's just no dividend growth.
Yeah.
Then you can get other consumer staples that are growing the dividend, like Target at the same yields. I much more prefer Target than Clorox.
Yes, I think that's a no-brainer, if I'm honest.
Yeah. But there are investors that are paying the price of Clorox today.
Yeah. But maybe dividend history comes into it, or maybe
I have no clue. It's probably the brand power, but it just shows you like how awkward the market is sometimes, don't you think?
yes, we talk about efficient markets, but that's all bull crap. There's always opportunities. There's always good and bad. There's companies that are backing. This is a good example of one that I would definitely not touch at 3% at the moment.
Yeah.
Good. Nice one. Unexpected. Yeah, we'll wait for European companies next year. I'll finish up with one. I just wanted to touch on VICI properties. I talk about them a little bit on the show. They've had quite a good quarter actually. 6.7% revenue growth, which obviously comes from rents. So they're making money from increased rents. Income from sales type leases was up 3.7%, and then they have this lease financing business, and that was up 10.7%. That's growing quite strongly as well. Adjusted funds from operation and funds from operation both increased. They paid our dividend from adjusted funds, so that's probably the one to look at more so, and that was up 8.4%. Cash flow was cash from operations was around 1.74, which is up from 1.6, I believe, this time last year. And their debt is around 0.64, so it's not overly leveraged with that. And of course, in the midst of all that, and I've missed this, they increased the dividend 4.2% over a few weeks ago as well, which gives them a CAGR of around 7% since IPO. So
nice.
They've been doing quite well. I suppose the only thing to remember with VICI, and I do talk about them, I do like them, but they are highly concentrated in a couple of tenants. And my mind has been on this because, I was recently in Las Vegas and I told you how much of a ripoff it is, and they're really milking that. It's like they're milking the last drop of milk from the cow. Like they're really trying to play on that. And lots of people when in Vegas and all this, but I just wonder how long that will last, because money will dry up, and what happens at that stage. So look, that's obviously a big concern. It's a major part of them. They are highly concentrated with 2 tenants spread over multiple properties over Las Vegas, but the numbers are good. Rents are going up 100%. Occupancy as well, which you can't give out about. So yeah, I think quite a nice quite a nice quarter from them. I'm happy shareholder. That they haven't got the same bounce as the other real estate investment trusts when they went up.
Yeah.
So I still find these attractively valued. They are diluting a little bit because they're investing quite a lot in acquiring properties and leasing and all that, but it's still.
It's nice to see, right? You always say you have a hand for gambling, but you're really living up to this quote now, like don't be a gambler, invest in gambling.
Yes.
Yeah. Don't buy Starbucks, invest in Starbucks. Yeah.
Invest in Star. They released their earnings actually. I forgot about them, but yeah, I think that's definitely the way to go. I've learned that the hard way. Don't gamble. Just own Evolution, own VICI. You don't need to gamble. You'll make the money.
Don't smoke, but just own Altria, British American Tobacco, Philip Morris, right?
Don't drink on Diageo, Pernod Ricard.
Exactly.
Harrisburg. Love it.
Yeah. Good. Well, interesting earnings. We could have spoken about several more still. We didn't speak about Chevron, not about ExxonMobil, not about some of the high-flying growth stocks like Apple, Microsoft. Well, Apple is not so high-flying at the moment, Microsoft neither, but some of the Mac 7, right? We didn't really speak about them. But hey, let's stay close to our circle of competence with these boring yet very entertaining, at least for me as a dividend nerd, earnings reports.
Yes. And with that, we'll move on to our listeners' questions. And we have quite a few to get through. So Alozier has two questions for us. And the first one is regarding diversification. So he's asking, what do you think about having more than one company in the same sector within your portfolio? Sometimes he thinks it can be a good approach if you have two companies of the same sector. So it's kind of like a safe kind of buffer within your portfolio.
Yeah. Well, I have about 50 holdings across 11 sectors. So, yeah, that's my answer already, right? So,
yeah,
no, but I think so. Why not own both? Why not own Coca-Cola and Pepsi if you believe in the long-term growth of such a drink, right? Why not own AbbVie and Bristol Myers if you believe in big pharma? Why not? You don't need to bet on one horse. Yeah, and specifically if there's secular growth trends supporting the industry or the market.
Yeah. And we always speak about diversification, and there's lots of different theories about this. But remember, we're not super investors. We're not privy to the same information that some of the big boys have.
Yeah.
So spreading your risk is always a good idea. And I'm the same. I have 40 companies over 11 sectors. So there's definitely some double up there somewhere. So
yeah, exactly. And we are talking even just about diversification within our stock portfolio, right?
Yes.
But if you really want to diversify, you also need to think about across asset classes, like maybe some real estate, maybe some gold, whatever it may be.
Yeah. There's levels to diversification. We'll keep it simple for now. And then the second part of the question is around brokers. We do get asked this quite a bit, but he's asking, can we mention what brokers we are currently working with?
So Interactive Brokers and the Giro, and they are like 50-50 for me. I have a small pie with the Noble 30 on Trading 212 as well. And technically I still have an account at Saxo Investor. I just need to close it.
The Giro and Interactive Brokers are the two I have. It was funny, we got asked the question. Do you remember the question about the debit card? The Trading 212. It was quite funny. I must have got about 7 or 8 emails of people who have it. And I was like, okay, guys, I'm sorry. Maybe I was wrong. It's quite a funny, quite funny, but all in good jest. It was kind of more they were making fun of me for it more so than anything, but I quite enjoyed it. We also got, you got a question. I don't know who this is from. There's no name attached. But the question is around a what-if analysis on your decision not to sell a certain stock. And to keep a long question short, what he's saying is, even when you decide to sell a stock, and I've noticed this as well, you don't pull the trigger straight away. You kind of wait, and maybe you sell it in trenches, and it's not always straight away. Whereas when and me personally, and the person who wrote this question, when I decide to sell, I sell it straight away. Once my mind is made up, I sell it straight away. So he's interested to hear your thoughts on why that is. Is it kind of a buffer,
Yeah.
or what that is?
So this question comes from Utdelningscontroller,
Okay.
and I think this is dividend controller.
Yeah, dividend controller,
Yeah.
yes.
It's actually quite simple. I'm sometimes just not in a hurry. Yeah. So when you buy those slow compounders, I mean, let's say if I would need to sell a position for 6,000-7,000 K, I don't straight away often have the idea. I mean, I own 50 stocks already, so it's not like I can easily redeploy 6,000-7,000 K at one time. Then, yeah, if it's such a position, so that's probably mostly the reason, because I do sell quick after a dividend cut. It's straight away. It's straight away, but specifically for the quarterly payers. But now with BASF, I started selling it, and I sold like half, I think, already. So I still have half to go, and that will be probably now before Christmas. I will sell the other half, because yeah, I don't really expect anything there to happen. It could be right, but it's for me more like opportunity in the market. If I would now have one stock where I think like, wow, this one is now so attractive, and I want to really quickly build up a large position, I would probably sell it all and straight away and redeploy the money. But then I have my rules again to not go too quickly into stocks. So it's mostly a thing about money. I can put it also on my balance sheet, let's say, as a cash position. Yeah, or I can just let it compound still a little bit.
Yeah. But if I think of ExxonMobil, there
Yeah,
was a period of time, if you remember, that you
yeah,
were set on selling them,
yeah.
and yet you never did. And
Yeah, because the earnings reports all the time told me a different story. I got a certain thinking about ExxonMobil during COVID at the time. I didn't see like their future prospects and anything, and I saw that Shell and the other oil majors were really investing also in more newer energy. But yeah, imagine if I would have sold ExxonMobil.
yeah,
Yeah, I've done fairly well. So it's a tricky one. But if there's really a strong dividend cut and there's a lot of shit in the market, I'm usually very quickly to sell. When it's like quiet waters, it's calm, then I'm not so much in a hurry. Specifically, not if I think that the company itself, I just maybe lost my trust or my belief in its future growth prospects, but I also may not believe that okay, well, it will drop in half overnight or something like that because there's something fundamentally wrong.
yeah. Unilever is probably another example of that.
Yeah. So for me, it goes kind of in my mind of I start to part from it, but then I want to see some more evidence maybe sometimes. And then actually Unilever and such, there was no strong need to sell it. Again, it's also about opportunity elsewhere, right? Because there's one thing is selling it, but there's also I get still monthly cash coming in from my salary. Yeah, so that probably has more to do with it.
Yeah.
And it has done me well. Yeah, I strongly believe in your portfolios like a bar of soap. You don't want to touch it too much, yeah, to enjoy it the most.
El Cuba has asked us about our thoughts on defense companies, military companies. Is the only issue related to Ukraine, or do you see bigger potential due to other tensions?
That's a question about how do you see geopolitics evolving?
It looks quite a tricky place at the moment. I mean,
Yeah,
it's hard to know with the news what to believe and what not to believe. But if you're looking at the news, there's tensions worldwide, not just
yeah,
Ukraine, not just
yeah,
Ukraine. And we do know that defense budgets have gone up. So yeah,
yeah.
I think in the next couple of years, especially Europe, based on Ukraine, I think maybe kickstarted Europe a little bit, but all over the world,
I
there's
think Europe has been underinvesting in defense for many years, and they're now trying to catch up.
yeah, exactly. Yuval has asked us about a formula. Do you have some kind of formula that takes into account the dividend yield and dividend growth to predict somehow what the yield would be in 10, 15 years from now?
Well, this is the Chowder rule. The Chowder rule looks at the 5-year past dividend growth history. on average, the CAGR plus the dividend yield. And if it's above 12, for most companies, utilities, they have a different, then you should be good. Yeah, if also the payout ratio is reasonable. And that's kind of what I usually apply, just as Chowder rule. It's kind of a simple test for me. I do, of course, my discount cash flow analysis typically, but the Chowder rule is a nice one as well. Just
Yeah.
to quickly check. How about you?
The Chowder rule is historically, though. I think the question is asking, do you have something to predict what the yield on cost will be in the next 5 or 10 years? And I think the closest thing to that is your dividend discount model, because you're using your dividend and you're using a growth rate that you assume that it's going to be over the next 10 years, whether it's 5, 6, 7, 8%, and you get a price.
Yep, but the other one is the rule of 72.
Yes, of course.
Yeah, so if you have a 3% yield and you expect it to grow by 7.2% each year, then after 10 years it should be 6% or something like that, and that's how you can also calculate.
Yeah, but to answer the question directly, I don't.
No.
I don't look at it and think in 10 years, 15, I'm going to have this yield on cost, so I'm going to buy it. It doesn't come in.
But I do have a table for it. So I have in a G sheet, I have somewhere a table where I have on one X, I have the yield, and then I have the yield in the top, and then I have, let's say, the growth, and then I have the years, and then I can see like how many years it would take for me to get there. So I do have such a table, and sometimes I look at it, but not often.
Jeremy has asked us about our plans are focusing for investing for the rest of this year. And how do you go about planning for each year's goals and focus areas?
I will just continue doing what I'm always doing, deploy my salary and those little tweaks in the portfolio that we just spoke about 5 minutes ago. That's it. And then when it comes to my annual goals, that's usually as part of my annual report. I really look back at the year, how it went, take learnings into account, and make adjustments. And that will lead to certain goals. Certain goals are always almost about my savings rate, and therefore how much I need to deploy at what kind of average yield to hit my target. But of course, I don't want to be blinded by the yield, because I don't want to step into yield traps and make awkward decisions. But I will monitor over the year whether I'm kind of aligned with that goal or not. If not, then I know that my journey will take longer.
Yeah, I'm similar. I have no special plans for the rest of the year. Just keep continuing. But I'm looking forward. I have my presentation. This will be my 3rd year of updating. It was a 5-year plan. This will be year 3. So I'm excited to see how far along I am. I present that to my wife then in January. She gets excited about it. She loves budgets and all this as well. So she looks forward to sitting there and talking. So yeah, I'm looking forward to that and seeing how accurate my plan was 3 years ago, and how likely I am to get where I want to be in 5 years. So that's how I go about it. Centrino has asked you a question about your type of financial independence. You're talking about you could be close to it in the next couple of years. So he's asking, can you describe in more details what that looks like for you? Will you still have to work? If so, how much, etc., etc.?
Yeah. So for me, if I reach financial independence, I wouldn't need to work anymore. Yeah. So it's really like real financial independence. Will I want to work? That's the hardest question at the moment. That's the hardest question. I've got like some people in my mind, like Ron Pizor saying like, guy, why are you on this journey if you want to continue working? Yeah. But then at the other side, I also know I'm kind of a social animal. I like what I'm doing today. I like to hang out with the people I work with. So, but this is just one giant mind fuck, to be honest.
It's so funny because you saw me laughing because we get asked this question and
often,
and we had a couple of shows on it, and I believe both of us have flip-flopped on our answers. and it's probably how we're feeling in that day or that week or that moment.
Exactly.
It's so hard when you're thinking about it in the future. And that's why I love hearing from the likes of Ron and there's so many others that are living it right now. because it gives
Yeah.
you a flavor of what it can be like.
Yeah.
And that's
But I can imagine like what we're doing in the newsletter to do that much more. Yeah, to spend much more time on that, create more content, but also really having the freedom of time that you can just. I mean, I had the other time, like last year, a few weeks off, and then just like you see the world turning and you're just like at 9, you take your coffee, you read something, you're sitting outside, it's nice sunny, you make a few plans, you go with your bike to the food market, you buy some stuff, you prepare some food. That is such a good feeling, and we don't really have time for that because we're in the rat race of work. And then in the weekend it's like, I don't know how it's for you, but it's like cleaning the house, doing some shopping. So to slow down, that will be probably one of my goals, at least in the beginning, to just slow down and to really absorb life more. Yeah, and you can go on vacation and everything now. You can do all the experience. You can spend a lot of money, but what we have shortage of is time and
yes.
freedom to spend the time we want, and that's what I'm mostly longing for.
Yep. Me too. Me too. That resonates. That resonates. I'd say with a lot of people, and it's you mentioned time is slowing down. It's something I definitely would, but I still need to have a purpose, and that's the struggle. What that purpose
Yeah.
is, whether it's work or whether it's outside of work, is. But I have to get to that point first. When I reach financial independence of that level, then I can start worrying about what my purpose. Will I continue working? Will I travel to different
Yeah.
cities? Talk about dividends? I don't know. Let's
But I
see.
think my purpose is already with this podcast is helping others on the journey as well. So I'm so motivated about that I'm quite sure that we'll continue doing something like that.
Awesome. Dividend not finance related, but thoughts on who will win the Premier League this season? Liverpool, City, or Arsenal?
I have no clue.
Yeah,
The Premier League is too hard, on the too hard pile for me to. I watch it every weekend, but predicting a champion,
I think predict the champion. I think it'll be City or Arsenal. Who do I want to win? I want Liverpool to win,
Liverpool. Yeah.
obviously. But City just look too good. Richard has asked us about Equinor. 66 billion market cap, zero debt, nearly an 8% dividend. Why is this European energy stock not really discussed by investors? He never heard of it before until you displayed it on a chart.
Yeah, well, let's say in the dividend growth investment community, I don't think it's that popular because it cut the dividend in 2020 also quite severely. Maybe that's why. Maybe because it's in Scandinavia, it gets less press here. I would say that it doesn't have the strongest oil and gas company profile. It's what is nice about them is that they're really diversifying into low carbon, low carbon energy sources. But if I'm correct, their reserve life is one of the weakest. So yeah, it can have a strong balance sheet now, but it will need it. But it's pouring a lot of money now in often not even profit making lines of business, right? I was looking at it with some of the oil majors for the preparation newsletter, but many of them they even just make a loss on all this stuff. There's no money really to be earned by those oil majors yet in the more new energy sources. That will need to pay off in the future mostly.
Yeah, and that it's not in a market that is familiar to everybody as well, because they
Yeah,
are
that's what I mean. Scandinavia. How often do
Scandinavian.
you? Yeah. The French know the Total Energies. We know Shell with the British.
Yeah, and then you have the American ones, which pretty much everyone knows as well. So it's
Exactly. And it's not like when I go to a gas station here, it's like an Equinor gas station that all the time triggers me. Yeah.
Andreas has asked us, in this moment, what would you choose? Realty income at $59 or Agree Realty at $74?
Yeah, that's a tricky one. That's really a tricky one. Oh,
So
uh,
I have a spreadsheet that I keep up to date every quarter. I have to still do it for this quarter, but for my three companies that I own, VICI, ADC, and Realty Income, I have the NAV calculation, and I got this from a book, Educated Real Estate, I think it's called. I must get a link for it, but it has a whole section on value and REITs, and calculating the NAV was one of them. And by that calculation, Realty Income is 26.96 overvalued at the moment, and Agree Realty is only 11%, and VICI is actually 4% undervalued. I know that's not included here. So if I was to go by that calculation alone, I would probably pick ADC. Even without that, I would pick Agree Realty based on their tenants, and I believe they have a stronger growth profile.
Yeah, I would probably say now Agree Realty also for the same reason, the growth profile, but also knowing that I have a lot of realty income.
Yeah, it's a tough one. Realty Income is the monthly dividend paying company. Everyone likes it, but no, I would pick Agree Realty.
I agree.
Flipomanic has asked us, why are you building a position in Ahold Delhaize and SHEL, which currently pay €1.11 and $1.38 in dividends to reach your FIR goals, instead of someone like Lindt and Sprügeli in Swiss francs, which pay, what's that, 1,400 Swiss francs in dividend a year?
Hallelujah. What's the share of Lindt?
You're looking at 10,310 Swiss francs.
Yeah. I mean, one share. Sorry, it's a bit too much for me to put it. I don't know. Usually, I don't have. I don't know about you, but I would need to save several months of salary, quite some months of salary, to be able to buy one share. I think that's the issue. Maybe I should think about fractional shares there, but then I wouldn't get this juicy dividend.
It's close to like €11,000 for one share if you're to convert it. I think it's 10,900. It's a lot of money, but I think the question is more around, maybe not around the specific companies, but
by the way, it is 101,000 Swiss franc, not 10,000. This company is trading for 101,000, and you can get 1,400 in dividends. So this is not just a few months of salary for me. A few years.
Yeah, that's even worse. That's even worse.
A few years. So I think that's the answer.
But I think the question is around, why invest in low yield when you can get good companies at high yield, I'd imagine.
But Lindt & Sprüngli is not a high yield. 100,000 and then 1.4K in dividends.
I still have 10,000 in my head. You're right.
Yeah. No, I don't think it's about the dividend. That's probably the highest dividend payment, but I would need to put 100K down, unless you do it all on margin, maybe. But
do you know what though?
I guess I don't understand the question.
Trading 212 does fractional shares, so you can start buying.
Yeah, but then I won't get the 1,400 in dividends per year.
No, you won't. Yeah, but look, a company like that is way out of my budget.
Yeah, for me as well. It's the same like the original Berkshire.
Yeah, I wouldn't even look into a company like that because of that.
No,
it's just
exactly.
a waste of my time.
But I think they have some maybe some alternative share, like maybe an A and a B. I don't know. Yeah.
Cool. JVB has asked us to talk a little bit about JGGI, and that's JP Morgan Growth and Income Fund. I'll talk about a little bit on this. Yeah, I don't think there's a whole lot to say. They have about a 4 or 5% dividend yield. They have a really nice dividend increase CAGR over the last 5 years. I can't remember what it is off the top of my head, but really what you get here is a mix of capital appreciation, and you get dividend income, and it's obviously managed by a fund manager, which is quite important. The gearing is quite low, and you get access to companies that I typically would not invest in. Some of these mag companies that you talk, these high growth companies, and you get that dividend income with them. So I always recommend people check out the AIC website. I think it's fantastic, especially for funds. But essentially, I invest in these because I get a mix of dividends and I get a mix of that growth that I would never ever typically invest in. So someone else can manage that for me. So that's all I have to say. I think they're under talked about in our community, particularly in the UK, because UK, that's where the investment trusts lie. And I've seen one or two people talk about them, but I think a lot more should. The dividend increases. I can't remember if it's around 8 or 9% per annum, but it's quite decent.
Nice.
David Andrew has asked a question about legal in general. The dividend yield is high. The company has been trading for a long time, but the share price keeps falling. What's going on here?
I can't answer that question, David. I need to look into it. I didn't do that yet.
Yep. Philippe then is asking about SCHD being available for European investors. So we know there's a loophole on interactive brokers that you can get access to these through options. So in that case, why are you not investing in it?
Well, actually, after the share split, it becomes maybe available again, but I don't want to just touch down $8,000 on a single purchase. That's what we're talking about there. If I would need to do it via the option trading again, that I don't have that money available on a monthly basis.
Yeah, but remember a few weeks ago we spoke about estate taxes and the different rules and regulations for European countries around that. And I mean, yes, there's a loophole around that, but that does not escape you from the risks of owning these. So we can't own them for a reason, and they're out of our investment world. And then we find a loophole and we own them. But I think that even opens you up to even more risks that we don't know. So I would stay away from it for that reason, more so than the cost. Estate taxes were really playing on my mind. I know Ireland has a really liberal relationship with the US based on that, but not all of Europe has the same, and you can be penalized quite heavy. So just be careful, just be aware of the risks and what it can cost you if it goes wrong. That's my thoughts. And we have plenty of good companies in Europe there. And then Sebastian has asked us, do you have more investing accounts for diversification if something happens to one of the other brokers? And we spoke about that earlier.
Yeah. That's why I have to hear on interactive brokers. Yeah.
And that is the last question of the show. Thanks a lot for all the questions, guys. Next week we have European earnings. We had no European companies today, which is, I think, the first time in a while when we do earnings, we typically try and single some European companies. So I'm looking forward to next week. Thanks for all the questions, and we'll see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.